Hello, class. I trust you are doing very well this week, week, another session. And so um, this evening, we are going to cover Learning Unit 5. And so just a reminder that Learning Unit 5 is the longest, I should say, the longest learning units that we have. And obviously, you are going to be writing this coming week and the next week, depending on which group you're in. And so there would be enough time given to you to concentrate, focus on your studies for the different tests that you have. And so just before the beginning of the assessment period, I wanted to cover this very important learning unit, at least start the conversation with the rest of the class on this very, very important learning unit. And as per the communication I sent out, this learning unit should give you a very good idea of how far you have come since the beginning of the semester. And it's going to be sort of an extension of Learning Unit 4. And obviously, from here on, Learning Unit 6 will be an extension of Learning Unit 5, and Learning Unit 7 will also be an extension of Learning Unit 6. Right. Hello, Tammy. Hello, Sierra. All right, so guys, I am going to speak for about 10 minutes or 10 to 15 minutes, and I will be stopping, just to check up on you if you're not sleeping and if you have any questions. I think this will be a very good place where we're starting and also a very good place where we're going to finish. All right, and you would understand why. But just to give you a broad view, if I were to summarize the entire Learning Unit 5 in one page, it would be this page. And obviously, like I said from the very beginning, we want to delve deep into inventory, into costs, and how we control the costs. This is very, very important. And so it's all about providing you clarity. And so I think these 4 sections speak to everything, right? So we have, the first thing will be the valuation, because we need to know what we have, especially in terms of inventory, right? So we need to know. And so one of the, so the tools we're going to be using would be obviously first in, first out. I'm quite sure you came across first in and first out in accounting, and weighted average cost. And the purpose, yes, is to accurately value inventory and to determine the cost of sales. We can't price correctly our product if we don't really know the actual cost of inventory, right? So the second part will obviously cover the optimization. And that's where the concept of EOQ, economic order quantity, would be introduced, and reorder points. But I think economic order quantity is the major principle there. And so, and we want to minimize the total inventory cost, and we want to prevent running out of stock, because it's quite dreadful to run out of stock when you are in the middle of production. Yeah. And just bear that in mind. So the other section will be the allocation. So we will be assigning cost fairly. What does that mean? What methods are we going to be used to make sure that we assign cost fairly. And what cost are we actually talking about, right? So very important to apportion shared service cost. When we talk about service cost, we are talking about service department, right? So if you would have like a production department, let's say maybe it is divided. It is divided maybe in two departments, right? A production department. Just picture yourself a production department or this big plant that is producing something, right? Service costs will be, for example, HR. HR will be service costs. You know, the HR department is not actually involved in the actual production, right? But it is a support department, right? I trust that makes sense, right? And the last thing would be we would just be looking at precision, right? So uncovering the true cost. So we just want to be very accurate, especially when you are in a very competitive industry, right? So you need to really, really ensure that you're controlling your cost. All right. So that's any comments from the class? I see a few things there in the chat. I was not looking. I'm not supposed to be looking, but I would have actually time now to have just a look. No problem, Tammy. And right. That's great, Sierra. That's great to hear. But again, we're gonna have this conversation now. Let me then take you to the very beginning, right? But please feel free if you would like to write down your question, or you just could wait, when I'm taking a break from talking, so that I can allow you also to share your thoughts, if you are able, right? If you are able, no pressure whatsoever. Okay? So, all right. So, like we said, it's all about inventory. So we want to understand everything about inventory. This is just a broad view that I'm giving you on Learning Unit 5. I'm going to try my best to make it as interesting as possible. But I repeat again what I said from the very beginning. It's the longest learning unit we have, right? But it's also the beginning of our advanced learning units, right? But I'm fairly confident that now that you have all your ducks in order, all your foundation is in, these principles, if you would go just by a read or just go through the, how do we call again, the virtual sort of pathway that I've provided to you, you would see that, it's fairly easy to understand. So I'm not really concerned about you guys because, your marks, how you are working speaks for itself. You guys have really done tremendous work since the beginning. All right. So I don't anticipate really that you would struggle. But for those, for example, who joined the class slightly late, right? So I would somehow think that, there could be issues here and there. But, maybe Ciara would tell us, it's fairly easy, right? So if you've started with learning in Unit 5, I'm sure that you're enjoying already. But I said, if you start, it's basically going to make your test too easy. So there was no pressure on you to start learning Unit 5, and you might have been focused really on learning Unit 3 and 4 because you were preparing yourself for the test. I don't blame you for that. But I'm just saying, when you arrive already at learning Unit 5 and you're looking back, you're looking backwards to learning Unit 3 and 4, you start to see learning Unit 3 and 4 very easy, you see. So that's the point that I'm making here. So if you want to actually go to your test feeling more confident, then start learning Unit 5. All right? Okay. So you need always to, with regards to inventory and cost, it's basically like an iceberg. And most of us only see the visible parts, right? But there is quite a lot of things that are hidden when we talk about inventory cost, right? So, but a business must be able to understand all the costs that are involved, especially if we are also looking at the manufacturing company. Why are we saying the manufacturing company? For me, it's such a beautiful, beautiful thing, right? The manufacturing company. Why am I saying that? Is because the variety of inventory and costs that are involved are larger than in a very, let's say, maybe trading company where you just buy and sell. You know, your trading company buy and sell. You see, but the manufacturing a manufacturing company would be more complex, and especially in terms of cost, right? So when you're looking, and this is actually a very good picture, right? So what is the true value of what we hold? How much should we hold? And when should we buy more? So those questions in mind, because every business you're going to be involved in, you have to ask yourself these questions. And there is also that part where I say there is things that are very hidden, right? So, but how do we fairly assign indirect costs? So when I'm talking about hidden cost, I'm just talking about indirect cost. What's another word for indirect cost, especially coming from our lesson last week? I just want you to write it down in our chat so that I'm happy. Just want to be happy a little bit that you are here, you are alive, and you're listening. There is a particular word, Ciara, that I'm looking for. You see, every time I speak about the three musketeers, you know them. I'm sure that it's in your brain right now, right? So what would be that hidden cost that I might be alluding to? Come on, guys. Of course. All right. Thank you so much, Ciara. Ciara to the rescue. So it's a pleasure again to see that overhead. You remember by overhead, I just mean whatever is indirect, right? So you have your direct material, you have your direct labor. You remember those two, and then you have your overhead. So anything that is indirect, and we said those indirects, obviously indirect, which is the opposite of direct. It's tricky to know how to attribute those costs or how to assign those costs, right? That could be rent. Here is my not really a question, but just something to bring to your mind. When you're thinking about rent, when you're thinking about administrative costs, right? And as it says there, for example, maintenance, how are you going to assign those costs to the actual product that you've produced? You see, so think about that, because we might just leave it aside and say, it's really not important, but that it is important. So gaining control over these costs is the difference between guessing and knowing. You can't be doing business or you can't be involved in business by guessing. And that's the purpose of you doing financial management, is so that you cannot rely on guesses. You have to know exactly how you would go about. Right. Okay, so defining the assets on our shelves. So in a manufacturing organization, inventory consists of three different components. And this is true. Like I said, make again the difference between a trading company, right? So the trading company would be purchasing inventory for the purpose of selling it at a profit, right? With a markup. that's slightly different from a manufacturing organization, right? So when you're looking at inventory in a manufacturing organization, you will see the direct material or the raw material, which is the basic material that is being converted during the production process, right? It's like your input. Remember, when you're looking at your economics 101, you always talk about input, processing, and output, right? So the same thing here. So when you're looking at your direct material, those are the premium material that you're going to use and you're going to transform those. For example, for shoes, yes, leather, glue, rubber soles for a shoe manufacturer, right? But there is also the other aspect you need to see, which is the working process. So the product is not yet finished, so we don't have the final shoe. So we're coming from raw material to something that is in the middle. So, and that would mean that we have started applying some labor and some overhead costs onto that raw material. But the product is not yet complete. It's not yet final. And then you have the final product. All of these three, just again, for all of you, I know some of you who always picture a balance sheet, because I always want you to have your balance sheet, your income statement always in mind, right? So these are financial statements, and I'm just picking these two, right? Your balance sheet, you know your balance sheet. What are we talking about when we talk about balance sheet? Assets, liabilities, and equity. All right? So we're there, all of us. Can you give me a thumb up? Am I making sense? Are you with me? Right. So you know, when I talk about balance sheet, don't tell me, oh, now look, you're taking us somewhere else. No, I'm not, because you aware since the beginning of the semester we talk about these things, right? So obviously, where are you going to put this? When you're talking about this inventory, these three things, where are you going to put them? In your balance sheet. Which section? And be more precise. So in our cut box there, just tell me where you're going to put this. Oh, Ciara, in the balance sheet, not income statement, the balance sheet, your asset, your liabilities, and your equity. Where are you going to put this? Ooh, where are you guys? Wake up. Did you get your coffee? Yeah. All right, Ciara. So it's going to be, and precisely what? So obviously, when you're looking at your asset, you're going to see your long-term asset as your non-current and your current asset. But where? Absolutely. All right. So Ciara is correct there. Please check the chat, everyone. So we would, when we look at this, don't always picture that, okay, no, it's not too complicated. I know where this is. So don't think about this. Remember, this is completed goods. It finished good, but it's not yet sold. I trust that makes the difference there, right? It's not yet sold. So when we're talking about sales, obviously we're moving where? To the income statement. Making sense, huh? So you are with me there, right? Okay, cool. So when you're looking at the critical choice between evaluation methods, obviously, perfect, Saskia, no worries. Obviously, and that's a good thing, by the way, of being online, is that you could be driving and actually in class, which is great. Right. So there is a distinction, by the way, I just want to make here, because I'm looking always, if you have your book open somewhere, I just want you also to have your book open, or your OneNote, whatever, if it's digital or physical. I just want to be true to Learning Unit 5. So in Learning Unit 5, you will see there is that distinction that is brought forth between inventory system and inventory valuation methods. So I'm speaking theory here. All right, it sounds blah, 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 but what is the difference between the two? All right, so inventory system, we are just talking about how we're going to record that inventory. And there's just two things that you need to keep in mind, by the way, that we already covered in Learning Unit 1. See, that's a good thing if you've gone through Learning Unit 1 to 4. And those two things are what? Perpetual inventory system and periodic inventory system. And I think, if I'm not mistaken, could be Ciara or someone else who asked me a very, very good question. And I said, we're going to touch that in Learning Unit 5, much deeper. But that, I think, if I'm not mistaken, it has to do with which accounts do we record when we're talking about perpetual. So remember, some of your questions, I've been keeping notes of your questions and answered them when the time comes, right? So when you see inventory, so perpetual inventory system, what does that tell you? I know it was a while ago. I know you wrote your test one a while ago. But what is the first thing that would come to your mind when we talk about perpetual? Yeah, go ahead, Tiara.
That inventory is recorded at point of sale. The sale of inventory.
Absolutely. Right. So basically, what are we saying? We're saying that we would know at any point we would know the value of the inventory because it is perpetually or constantly recorded at the point of sale, like Ciara said. And therefore, that's the reason why we're making use of the inventory account. All right, so that would make sense because we have an inventory account. And when a product is sold, automatically that would be attributed, or how can I say, affected in your cost of goods sold. Did I make it complicated, or does that make sense? So you would see that your balance sheet and your income statement would perfectly work together. What is the best way, to describe that? It's like you're pressing a button and something happened. All right. So these two will come alive. They would work in tandem together. They would so the action happened, something was sold, and automatically it's appearing on the other side. So I trust I'm not confusing you on this. But basically, to say that's the purpose of linking these two statements, your balance sheet and your income statement. So as soon as the inventory is sold, automatically, remember your income statement. I'm testing you guys already. I'm really testing you every time. So what are the, how do you see the income statement? What are the two things that every time I talk about income statement, what are you thinking of? Things, just two things. Plus minus, right? Ins and outs, right? It's just a series of inflows and outflows. We agree, right? So the first thing always, the first item on your income statement would be what? Sales. The second thing would be what? Cost of sales, right? Are we on the same page? All right, good. So there's a thumb up there. I'm happy. All right, so and I'm saying, look at the second item in your income statement. Automatically, that will react. So when you have a perpetual system, it's happening live, sort of to say. It's streaming live. So automatically, if an inventory is sold, automatically there in the cost of goods sold, which is part of your cost of sales, something should happen there. All right. But that will not be the case for periodic. For the periodic inventory system, remember the inventory system is about how we recording. Would that be the same thing about the periodic? Because periodic says a period, and it will always be at the end of the period where we do the stock take. So if the end of the period is one after a month, so we would need to wait until the end of the month to do the stock take, and then we would know what happened. So we wouldn't even know the cost, actually, the cost of inventory in the middle of the month. And the good thing, guys, is we will not make use of the inventory account. We will make use of a purchase account. So purchasing, buying, and maybe sometimes we have to return something we purchased to the supplier. We would record that in a purchasing account. Does that make sense? Are we good? Perfect. All right. Okay. So now, obviously, I've just covered what inventory systems are, not to be confused with inventory valuation method. How do we actually value the cost of inventory, right? How do we value? That's where first in, first out comes in. That's where weighted average cost, or WACC, comes in, right? So we first in, first out. I mean, that's quite simple, right? It's quite simple. And by the way, these would have a direct impact on how we report our profits. They would have a direct impact, right? So, but the closing inventory on the balance sheet is valued at the most recent purchase prices. That first in and first out. That makes sense, right? First in, it's the one that is coming out. So how we value the closing inventory in, on the balance sheet, how we value it would always be related to the most recent purchase prices. And that makes sense. During my time, we were using the last in, the LIFO, last in, first out. But obviously, that is no longer standard. Just that's for your own good sake. Just don't deal with that. So it's not applicable here anymore. All right. But it's something that we used to use during my time, right? So makes sense. But now for the weighted average, why do we use the weighted average? Because we weighted average, it means that we're smoothing out the effect of what? Of price fluctuations on the reported profit. Because it is true. You might be in an environment where the price is always fluctuating, right? So now you would say, but I would prefer the FIFO method. I would prefer the WACC method. No, it would have to be with regards to what kind of industry you are. If the price fluctuates all the time, then you would rather use the weighted average. Makes sense, right? Because there's too much ups and downs in the pricing. But if you have some sort of stability, price, doesn't move that much up and down, then, first in, first out could be the best method, right? So it depends. You can't say. And by the way, a good question for your exam. And by the way, note this down. It's going to be in your exam. So don't say, okay, we're studying this, but is it really applicable? Everything we do in finance is applicable. And that's why after we've covered something, there's always an example for us to work on, right? Right. Let me check. Just a slight break now. Let me see. Ciara is saying, absolutely, absolutely. So we have actually a very good example, Ciara, in the textbook. I don't. Not only that, you would see that we have already some uh, um, tutorials, but you don't need to go look for those tutorials. They are in the virtual pathway that I always put out. So when you start the virtual pathway, which you know from point A to point B, right? So when you start to go through that virtual path, you will have very good examples. And actually, check also your OneNote. This beautiful annotation actually covering that. But you don't need to worry. Should you go through the pathway and still have any question, please raise this up again. But I can guarantee you, you would not have even a single question because I've made it so easy. And in fact, I've put all these methods. So these four things, right? So inventory system together with the inventory valuation methods together in one table where you have one example and you have these four things. How you do LIFO into the perpetual, how you do LIFO into the periodic, how you do weighted average into the perpetual inventory system, and how you do the weighted average in the periodic. All of them in one table for you to see and to clearly see the difference between the two. So that would be very good for you for the exam because in the exam they could ask you, to solve to use the weighted average cost, right? And then they would say, oh, but in the periodic inventory system. So some students, if you cannot see it or picture it in your mind, it's going to be difficult. Sometimes I see students maybe using LIFO when we were asking weighted average. So yeah, that would not be the best really. All right, guys, are we good? Shall we move forward? All right, so this is an example. I'm just giving you an example. Obviously, like I said, they are tutorials and they are parts of tutorials that covers everything for you. So you just need to go through the virtual pathway that is there on ARC. It's there, it's waiting for you. By the way, in the posts as well as in the announcement, Learning Unit 5 has already been shared with you. So this is just one of the example that was covered. What I want us to think about is, do you see the differences between FIFO and weighted average cost method? When you're looking at the value of the closing inventory here, you can see it's 7,198. And here for weighted average is slightly more, 7,228. Do you see that? Obviously, depending on the company, this might be small difference, but let's say maybe we are talking in millions or in billions. So you can see already that this slight difference, right, between FIFO and weighted average, we might be talking about massive amounts, huge amounts, right? So here it's just because it's in thousands, but let's say it's 100,000 or 1 million or 7 million. Let's say this was 7 million with 3 zeros there, or it was 7 billion. You can see already that these slight differences could mean quite a lot, right? But as you can see here, we start by valuing the closing inventory. We have the cost of sales, and we have the gross profit. And you will always have it you see that it will always come. We would ask you, for example, for the gross profit, which is where, which means that you are moving from what? From your balance sheet to your income statement. You see how they work together beautifully. So just keep that in mind.